Fed Chairman Powell talked yesterday, and it was almost all dovish. Next. We're going to go over what he said as well as some inflationary numbers, and we're going to wrap it up with another good day in interest rates. Welcome everyone to Real Estate Daily. My name is Troy, and every day we go over the latest news in real estate, mortgage, and the housing market. Now, before we jump into it, do me a favor. It helps my channel out. Hit that subscribe button. Boom, boom. Let's continue to grow this channel. We're excited. And this is going to give you the best 5 to 10 minutes in real estate on a daily basis. Now, let's kind of jump into this. First article here is kind of coordinates here with the Fed yesterday. So Fed Chairman Powell talked yesterday. Everyone was waiting another I'll call it a milestone on what was going to happen going into the future. And what did he say? He said that they're going to ease the amount of the percentage that they're actually going to, or the amount they're going to, again, grow every single month going in the future. Now that was taken very dovish. He talked about a lot of the numbers in October being better than expected or right at where they needed to be. And now October, it looks like the gas prices are down because of China. It looks like there's a lot of things happening over there. And one thing that's not happening is people getting out and using oil or gas to get around the country. It looks like it's pretty much down. Because of that, it's put a little more gas on the market. And because of that, it's becoming really good to see that we have it available to us and that those have gone down. It really is one of the best moments here in the last 12 months in inflationary times. But I don't know if that's going to last, but right now it feels good. So with that being said, we got Powell being very dovish. Key inflation measures that the Fed follows rose 0.2, which is less than expected. But what we are seeing is that a little bit more pushback, from the Fed or from people from the Fed. Elon Musk is not happy. Now, I've seen a lot of analysts out there saying, guys, we've got to hit the brakes. We can't keep raising it at 0.75. And that's what basically Powell said. I'm not raising it anymore at 0.75. But that means 0.5. That still can be fairly damaging. I mean, it's almost as if we want to take a pause, and this is what I would do. Take a pause in December, see where it's at, see what's happening. Is the unemployment going up significantly? Is it not going up significantly? It looks like he's going to do the Fed's going to do a 50 basis point raise. But it looks like a lot of people have said it. If you over tighten, it's a slingshot effect. Whatever happens today in tightening doesn't mean it's going to happen tomorrow. It means that it affects something that's 6 to 12 months down the road. If you tighten too much today and then all of a sudden you decide to hit the brakes, well, you still have 6 more months, if not 12 months, of devastation that you caused. So Elon Musk says the Fed must cut rates immediately to stop a severe recession. I don't know. I continue to have, influencers as well as analysts come out and say that. They don't see it in the same light. I think that, when it's all said and done, I don't know if they're even using any of their mentors' guidelines, which I don't believe they are. It's a big, if I go back to Paul Volcker, that was 40 years ago. The economy was significantly different. It was significantly smaller, and the world wasn't as affected by us. Today, the world is extremely affected by interest rate hikes, as well as it's affected by our monetary policy. So with all that being said, Elon Musk says you hit the brakes or we're just going to have a big issue somewhere. And I believe we're going to have it in the next 6 months. It's going to be fairly devastating to our economy because I think that we're going to see this ball is rolling downhill. You got to be able to get behind it and stop it, or it's just going to roll over you, get some momentum, and crush us. Here's the next bit of news. And like I've said before, collateral damage. When the Fed raises rates, what's the collateral damage? Collateral damage is in the real estate rates, mortgage markets, and sales markets, as well as consumer debt. Consumer debt, the rate in which credit card interest rates have gone right through the roof. I think the last time I saw it, it was like a 29 point whatever percent is your average credit card. I don't think, and Americans are in more debt today than they were ever. Those two things that's bad. That is terrible. Now, I don't know if the Fed's looking at that, but if we have a huge credit card default somewhere in the future, that is going to be bailouts. Bailouts meaning that I got to print more money. More money meaning that we'll have higher inflation. Guys, this is what's happening. That's why people are saying stop raising interest rates. They're only hurting the middle to lower class people. They're not hurting the rich. The rich aren't being affected. They can afford $5 a gallon. They can afford $10 a gallon to fill up their cars. But it's the average working day person that's making a decent living, that doesn't own a house, that has to deal with rents going up every single year, that has to deal with, gas prices going up all the time, food prices going up, insurance is going up, everything going up. Those are the ones that are immediately affected. We have to stop this. Otherwise, we're going to see a capitulation moment that's going to crush the stock market, crush the S&P, and crush the crypto markets all at once. Maybe we need this. Maybe we need this shakeout, but we surely don't need the government to over-tighten and then come back and try to bail us out, because if that's the point, if that happens, that means they want it to happen. And why do they want it to happen? Because they want us to rely on them. Stop the STEMIs. Let's put that sign up. Stop the STEMIs. Next. Well, again, what's happening in the credit markets? We saw that interest rates went down yesterday. I want to clap here. I know 30-year conforming conventional still over 6.5. We need to get that down. But everything else dipped to where I needed it to be. 15-year conforming down 11 points, under 6%. That's great. Jumbo went down 8 points, under 6.5. Let's get that under 6. That's where it needs to be, especially here in Southern California. And then 30-year FHA went down a little over 3 percentage points, under 6.5. We need to get that under 6.25. I'm excited about this. I know that there's not any inventory on the market and there's buyers out there. We're seeing a little bit of resurgence here in the fourth quarter. It's going to be interesting. Can we take that momentum into the first quarter of next year? We're going to find out. December 14th is going to be a big, big day. That's when the Fed meeting hits again, and we're going to find out what's going to happen after that. Numbers are going to come out tomorrow about unemployment rates, and then we'll wait a couple weeks to see what happens with the Fed. Guys, thank you very much for joining me today. I am excited about this market, especially right now, the little resurgence that we're seeing. But ultimately, let's keep this ball rolling. Guys, you have a fantastic day. You have any comments, please leave them below. Otherwise, hasta la vista, baby.